Good day. The lecture is on recording transactions into the subsidiary journals. Prior to this, you have learned to do the following. You have done calculations on value-added tax to determine input and output VAT on qualifying income and expenditures. You have also worked on calculations of markup where perpetual inventory system is in use. Lastly, you understood the use of various source documents to generate information that must be recorded into accounting records. The following are the various subsidiary journals that must be prepared to record daily transactions as income is received and as expenditures are incurred by the business. A cash receipt journal will be prepared to record all cash receipts of income. The cash payment journal will be prepared to record cash payments for procuring of goods and services. The petty cash journal will be presented to record cash payments made for small item purchases. The accounts receivable journal, also known as a debtors journal, will be presented to record goods sold on credit to clients. The account receivable allowances journal, known also as a debtors allowance journal, will be prepared to record goods returned by clients. Accounts payable journal or a creditors journal will be prepared to record goods purchased on credit from suppliers. Lastly, the accounts payable allowances journal or a creditors allowance journal will be prepared to record goods returned to suppliers. Before we can start recording into various subsidiary journals, let us recapture on calculations done previously on value-added tax and markups by working on the given table below to determine the missing values. On the table, we are given VAT, which is applicable at 15% on qualifying income and expenditures. We are also given the following columns: a summary of transactions column, the mark price including VAT column, the output VAT for qualifying income, the input VAT for qualifying expenses, the sales excluding VAT column, the gross profit column, and the cost price excluding VAT column. We will start with the first transaction where goods were sold which were marked at 150% on cost price, given the cost price amount of 10,000 rand. The amounts that are not given in this line transactions are the following. It's marked price, including VAT. Because it's a sale transactions, it will qualify for VAT. Output VAT is not given, as well as the selling price excluding VAT. To determine these missing figures, we need to analyze information that was given. Goods were marked at 150% on cost price. Therefore, to determine the values that are missing, we will have to use the cost price as our base. Now, the first item that we need to calculate here on this line will be sales. Why sales? When we are dealing with a selling transaction, VAT is added on the selling price, not on the cost price. In this line, we are given the cost price. Therefore, we will first have to calculate the sales so that we can determine the output VAT that must be added to arrive at the selling price, including VAT. To do that, we will then use the following information. We will say if cost price is given as a base, we will then express it as 100%. Markup is given as 150%. We will add it to the cost price percentage to arrive at the selling price percentage of 250%. Cost price is given as an amount of 10,000 rand. Selling price, it's not given in rands. It's an amount that we need to determine. To do the calculations for selling price in rands, we will use the following formula. We will take the amount given, multiply it by the percentage which we did not know that we must determine, divide it by the percentage that corresponds to the amount given. Therefore, our calculation will be done as 10,000 multiplied by 250 divide by 100 to arrive at a selling price of 25,000. Then multiply 25,000 by 15% to arrive at output VAT. We will take 25,000, multiply it by 15, divide by 100. Where are we dividing by 100? We are using the amount that is exclusive. We will then arrive at output VAT of 3,750 rand. We will add the VAT to the sales to arrive at the selling price, including VAT, of 28,750 rand. In the second transaction line, we are given trending inventory, which was purchased for 24,600 rand, including VAT. Inventory qualifies for VAT. Therefore, on this line, amounts that are not given are the input VAT and the cost price of the transaction. To do those calculations, we will then first determine the input VAT on the inclusive amount by taking 24,600, multiplying by 15, dividing by 115. Why are we dividing by 115? It's because we are using the amount that is inclusive. Therefore, our input VAT will be 3,208 rand 70 cents. We will deduct it from the inclusive amount to arrive at a cost excluding VAT of 21,391 rand 30 cents. In the third transaction, fuel is bought and the cost price excluding VAT is 3,100 rand. Fuel is zero rated, therefore the total amount paid in that line transaction will be 3,100. In the last line transaction, sales of goods marked at 35% on selling price were sold at a gross profit of 2,300. The amounts that are not given in this line are the mark price, including VAT, the output VAT, the selling price excluding VAT, and the cost price excluding VAT. Now, to calculate the missing figures, we again analyze information given, where mark price was calculated on the base of selling price at 35%. To do that, we will then use the selling price as our base. Because selling price is our base, we will express it as 100%. Gross profit margin is given as 35%. To determine our percent for cost profit, we will then deduct the gross profit from the selling price percentage to arrive at a percentage of cost price of 65%. Please note the following. When we do calculations on perpetual inventory system, it's important to take note of the base that is given. In the first example or the first transaction, the base for calculating the markup was given as cost price. Therefore, cost price was expressed as 100%. In this line transaction, selling price is given as a base for calculations. Therefore, selling price will be expressed as 100%. In this line transaction, the cost price value is not given, but we are given the gross profit value as 2,300. The selling price value also is not given. Now we will either determine the cost price or the selling price. In this example, we will start by calculating the cost price value. We will use the same formula that we used in the first transaction. We will take the amount given, multiply it with a percentage that is unknown, divide it with a corresponding percentage to the amount given. In this case, we will take 2,300, multiply it by 65, divide it by 35 to arrive at a cost price of 4,271 rand 43 cents. We have calculated the cost price. We can now add the gross profit to arrive at the selling price excluding VAT of 6,571 rand 43 cents. Because VAT is added on sales, we will then calculate our VAT on the selling price amount by multiplying it by 15 and dividing by 100 to arrive at the output VAT of 985 rand 71 cents. We will then add the output VAT to the selling price to arrive at the selling price including VAT of 7,557 rand 14 cents. In this exercise, let us analyze the type of transactions that are represented, determine the subsidiary journal for each transaction, and record them into relevant journals. The information is extracted from the books of Ulandi Traders for March 2018. VAT at 15% is applicable on qualifying goods and services. The trader uses perpetual inventory system. Goods are marked at 30% on selling price. You are required to prepare the relevant subsidiary journals. Transaction 1. The owner transferred additional contribution of 250,000 rand into the bank. That's a direct deposit. Number 2. The following expenditures were incurred. Stationery bought from P&A Stationers for 750 rands. This is stationery bought on credit. Vehicle bought from XPS dealers for 455,000 rand. A deposit of 55,000 rand was paid. The balance will be settled through installment payments. Here, a vehicle is bought on credit, but a payment of 55,000 rand was made. Two things in that line transaction. Number 3, goods bought from Gamma and Sons and paid for cash. The amount 22,200 rands. Line 4, the trader made a transfer payment to A Apple to settle an amount due. The amount 880 rands. That's a cash payment transaction. Goods were supplied to the following customers: B Brown 7,150 rands. Swart, goods that were supplied cost 1,339 rands 13 cents. These are goods sold on credit to debtors. Transaction 6, Peapod Lot settled his account of 1,200. A discount of 6% was allowed to him. This is a receipt transaction. Number 7, trading inventory bought from Maxi Traders. The amount 3,700 rand. This is inventory bought on credit from a creditor. Number 8, goods sold for cash, 13,660 rand. Clearly, this is a receipt transaction. Number 9, a credit note of 150 was issued to B Brown for an overstated invoice. This is a credit note transaction. The following checks were issued: salaries and wages, 36,230 rands. Relish to City Press, 2,550 rands. These transactions are cash payment. 11. The trader received a credit note from Maxi Traders of 255 rand for goods returned. This transaction deals with goods returned to supplier. The last transaction, a tenant made an EFT monthly payment of 2,300 rand. This is a receipt transaction. We will start first by recording cash receipt and cash payment transactions into relevant subsidiary journals. The first journal is the cash receipt journal. In this journal, we will record income received. The source documents that will be used are the duplicate receipt for income received, the cash register roll for cash sales, the bank statement for all EFT deposits as well as other direct deposits. The second journal will be the cash payment journal. In this journal, we will record the cash payments. The source documents that will be used in the journal are the check counterfoil and the bank statement for EFT payments, debit orders, and stop orders. The subsidiary journals are prepared in a columnar format showing the name of the subsidiary journal and the month on which transactions are made. Therefore, for our example, our cash receipt journal format will be as follows. It will be a cash receipt journal of Ulandi Traders for 31st of March 2018. The first column will be a source document column. It will be followed by the date of the transaction, the details of the transaction, then the bank column to record the amount including VAT of the transaction. Next to the bank will be the output VAT for qualifying income. Then the sales column excluding VAT, the cost of sales where perpetual inventory system is in use, the accounts receivable for accounts paid by debtors, then the discount column where discount has been allowed to debtors, the sundry column for amounts excluding VAT that will only be received once in a month. Next to the sundry column will be the column to write the account details of the sundry entry. Then our cash payment journal will be prepared as follows. It will be a cash payment journal of Ulandi Retail Stores for the 31st of March 2018. The first column will be a source document column, followed by the date column, then the details column of the transaction, the bank where we will record amount including VAT, then the input VAT column for qualifying expenditure, the trading inventory column which will exclude VAT, the accounts payable column where we will record payments that are made to creditors, the discount received column if creditors allow us discounts, sundry column for exclusive amounts that will be paid once in a month. Next to the sundry column will be the details for the sundry column. In the previous slides, we have analyzed the transaction as cash or credit or returns transaction. Now, let us start to record all cash transactions from our example. The first transaction that involved cash was where the owner transferred additional contribution into the bank account of the business. This transaction, because it's a cash into the bank account, it will be recorded in the cash receipt journal as follows. The source document will be a bank statement. Why a bank statement? Because it's a direct deposit. It was deposited on the first. Under details, we write cash because it was cash deposit. In the bank column, we reflect the total amount of cash that was deposited, which is 250,000. Now, this transaction involves a deposit. It's not cash receipts, or it is not cash received from sales of any good. Therefore, it does not qualify for VAT. Then it will be directly shown under the sundry column because it's only a transaction that will take place once in a while. And the details of this transaction will be capital. Why? When owner contributes into the business, contributes cash into the business, we said contribution of owner in our books will be recorded as capital. Now let's look at the next transaction. In the next transaction, we have the following expenditures which were incurred. Stationery bought from P&A Stationers for 750. We said this is a credit transaction, therefore it will not be recorded in the cash journals. A vehicle was bought from XPS dealers for 450,000 and a deposit of 55,000 rand was paid. The balance will be paid in installments. Therefore, the vehicle purchases was not on cash basis. The vehicle was bought on credit from the dealers. But we have paid a deposit of 55,000 rand. Therefore, the 55,000 rand is the amount that must be recorded in the cash payment journal because it involves a check payment. We will then record it as follows. Under the document, the source document column will reflect the cash counterfoil as a source document issued on the 2nd of March to XPS dealers. The total amount paid 55,000 rand, because now this 55,000 rand was not purchase of goods. It does not include VAT. It was a payment of a deposit. Therefore, we will record it under accounts payable. Why accounts payable? It is because it's a part payment of an account for buying a vehicle. It was paid as a deposit. The next transaction is transaction number 3, where goods were bought from Gamma and Sons and paid for 22,200 rands. This transaction deals with cash payment. It will therefore be recorded in the cash payment journal. Now you will see that in the cash payment journal we've already recorded the deposit of 55,000 francs. Then now this transaction line 3 will be recorded as under source doc. We will then go to source document and show the check counterfoil, the date this transaction took place on the 3rd, the details of the payment. We paid Gamma and Sons. Under bank, the amount paid was 22,200 rand. Because we were paying for inventory, it qualifies for VAT because these are goods that we purchased. Therefore, we will then calculate VAT by multiplying by 15, dividing by 115 because the amount is inclusive, and the VAT that we will calculate will be 2,895 rand 65 cents. Then we will then take the total amount, deduct VAT. Then under trading inventory, we will show the amount excluding VAT of 19,304 rand 35 cents. The next line transaction is line transaction 4. In line transaction 4, the trader made a transfer payment to Apple to settle an amount due of 880. Line transaction 4 will affect our payments. Therefore, we will go to cash payment journal because it's a cash payment. Then under source document, we will reflect that this was a transfer payment. Therefore, our source document will be a bank statement. The transaction took place on the 4th and we paid Apple. The total amount paid is 880. Now this 880 was not a purchase of goods. We were paying an account. Therefore, because we were paying an account, the transaction does not include VAT. This 880 was paid to a creditor. Therefore, the 880 will then be shown under the accounts payable. The next transaction line, it's line number 5. In line 5, we supplied goods to the following customers. B. Brown for 7,150, and to Swart, the cost was 1,339, rand 13 cents. Now line transaction 5, we said it's a credit transaction. It will not then affect our cash journals. Let's move on. In line 6, People Float settled his account of 1,200 rand. A discount of 6% was allowed to him. People Float in our books is a debtor. He is now settling his account of 1,200. This entry, it's a receipt, therefore it will be recorded in the cash receipt as follows. Under the accounts receivable column, we will record the total amount that was owed, which is 1,200. Of this amount, because we are allowing a 6% discount, we will only be receiving 94% of the amount owed. Therefore, in the bank, we will reflect the actual amount that we are receiving, which is 94%, which will be calculated as 1,128 rand. The difference of 72 rand will represent the discount that was allowed. But now included in the 72 rand, it's output VAT that we will never recover. Therefore, we need to determine the VAT that is included in the discount so that we can reduce the output VAT column with the amount. The 15% of 72,000, because it's inclusive, it will be calculated as 9 rand 39 cents. Then we will deduct it from the 72 rand discount so that under the discount allowed column, we only reflect the amount excluding VAT of 62 rand 61 cents. The next transaction line, which is 7, deals with a trading inventory bought from Maxi Traders for 3,700. This entry is inventory that was bought on account, therefore it does not affect the. In line transaction 8, the goods sold for cash 13,660 rand. This is a receipt transaction. It will therefore be recorded in the cash receipt journal as follows. Under the source document, we will show a cash register roll, the date, the 8th, under details, cash. In the bank column, the total amount for the sales, including VAT, 13,660. Sales is a qualifying income. Therefore, we are also collecting the output VAT. We determine then the output VAT by multiplying by 15, dividing by 115 because it's an inclusive amount. Then VAT will be calculated as 1,781 rand 74 cents. We deduct the VAT from the inclusive amount to arrive at the value of 11,878 rand 26 cents as our sales excluding VAT. In this exercise, a perpetual inventory system is used, and we are given that goods were marked at 30% on selling price. Selling price is our base, therefore we will express it as 100%. If markup is 30%, to calculate then our cost percentage, we will deduct the 30% from 100 to determine the cost price of 70%. To now calculate the cost of sales, we will take the amount that we know, which is the sale of 11,878 rands 26 cents, multiply it by the percentage that we don't know, which is 70, divide it by the percentage that is related to the amount given, which is 100, to arrive at a cost price of 8,314 rand 78 cents. In the next line, it's a credit note of 150, which was issued to B. Brown for an overstated invoice. This amount has got nothing to do with cash journals. Therefore, it will not be recorded in any of the journals. The next line is transaction number 10, which reads as, the following checks were issued: salaries and wages, 36,230 rand, Relage to City Express, 2,550. This transaction affects the payment. Therefore, they will be recorded in the cash payment as follows. Under source document, we will record the check counterfoil dated the 10th. For salaries and wages, the details will be cash. Under the bank, we will reflect the total amount of 36,200 rand, and salaries and wages are not qualifying expenditures. Therefore, we do not calculate VAT. We will then reflect the amount under sundry column because salaries and wages are only paid once a month. Therefore, the details for 36,200 under the sundry column will be salaries. The next item, which is a check which was issued for Relage, the source document for the transaction will also be a check counterfoil dated the 10th, issued to City Press. The amount is 2,550. Relage is a vetable item. Therefore, we will calculate VAT by multiplying by 15, dividing by 115 to arrive at an input VAT of 332 rand 61 cents. Then we will deduct the input VAT from the bank, and then we will arrive at the trading inventory amount of 2,217 rand 39 cents. Note that the Relage is allocated under the inventory column because when we are using the perpetual inventory system, we do not keep a separate Relage account. This will be the same also where we are paying the import duties and the freight charges on inventory delivered. The next transaction will be transaction 11, where the trader received a credit note from Maxi Traders of 255 rand for goods returned. This transaction does not affect cash journals. The last transaction is line 12, where Mr. Toga, a tenant, made an EFT monthly payment of 2,300. An EFT will be a direct deposit. Therefore, it will be recorded in the cash receipt journal as follows. Under the source document, we will show it as a bank statement entry because it was a transfer payment. Dated the 12th. The details of the transaction, it's a tenant, Mr. Toga. We write Toga. In the bank column, the full amount that we have received, 2,300 rand. Rent received for business qualifies for VAT. Therefore, we will determine the output VAT on the inclusive amount. and the VAT that we will calculate will be 300 Rand. Then under the sundry, we will reflect the actual rent received excluding VAT of 2,000, and the details under the sundry column will be rent received. Rent is a sundry item because it's a transaction that will only occur once in a month. Now we have recorded all the transactions for March for Ulandi. Then at the end of the month, all the journals for the month must be closed and balanced off. To close off our cash journals, we will have to calculate and determine the subtotal for each column. We will start by calculating the bank total. To arrive at a total of 267,088 Rand. The total for output will be 2,072 Rand 35 cents. The total for sales, 11,878 Rand 26 cents. The total column for cost of sales, 8,314 Rand 78 cents. A total for accounts receivable after we've added all entries, 1,200. Total for discount allowed, 62 Rand 61 cents. The total for the sundry column, 252,000 Rand. Then from there, we will have to do the cross-casting by adding all the subtotals that were included in the bank. Then to do that, we will then take the output VAT, add sales, add accounts receivable, less the discount because the discount was not included in the bank. Add the total of the sundry column. It must give us a total of 267 and 88 Rand, which was calculated as a total for the bank column. We will also do the same thing with the cash payment. We would close it off by calculating the totals for the different columns. The total for the bank that we've calculated is 116,830 Rands. For the input VAT, we've calculated 3,228 Rands 26 cents. Trading inventory, we've calculated 21,521 Rands 74 cents. Accounts payable, we've calculated a total of 58,880 Rands. No discount was received in this exercise. The total for sundry column was 36,200. Then we will do again the cross-casting of the cash payment journal. We will take the sundry total, add the accounts payable. If we had a discount received, we will deduct the discount received. Add the inventory total, add the input VAT total, and arrive at the same total that we've reflected in the bank account.